I'm Lucy Ferreira for biznews.com, and with us today we have Sagneeth Sewnath from NinetyOne, the biggest listed asset manager in South Africa. Sagneeth is the Deputy MD, and he's going to be helping us demystify some of the headlines that we've been seeing about the changes to Regulation 28 and the expected capital outflows that are going to be leaving the country. Sagneeth, it's been a busy time for you.
Lucy, thanks for having me. Yes, it has been a busy time, but hopefully we can unpack some of what this means for your viewers.
Thanks, Sagneeth. So I think my first question is, what is Regulation 28? For those that are seeing big numbers, they're scary, what is this even?
Yeah, Lucy, I mean, it's an important discussion. The Regulation 28 is basically a set of rules that govern what investors, retirement fund investors, can invest in various different asset classes, as well as what they can invest locally as well as offshore. It's a fairly old piece of regulation that has evolved and changed to adapt with the environment over the last few years.
And up until recently this year, the limit of the funds that could be taken offshore for investment was 35%, and that has just been raised to 45%. And that is obviously where the prediction around the massive capital outflows that we're looking at. How did your analysis team get to that number?
Yeah, so let me just clarify what the limits were. So it was
Thank you.
there were two levels. Up until February of this year, there was an offshore limit, which was 30%, which meant that people could take 30% of their money outside of South Africa into global markets. Over and above that, there was a second limit of 10% into Africa, excluding South Africa. So it brought the total limit up to 40%. In the February 22 budget speech, that limit was increased to 45%, but they simplified, National Treasury Reserve Bank simplified that into a single level of 45%, which included Africa ex-SA as well as global. So you could decide that full 45% went into global equities, global investments as an example, or you could invest that full 45% into Africa ex-South Africa. So that limit of 30% plus the 10 Africa went up to a single level of 45%.
Thank you. And I was going to ask for clarification on the Africa portion as well. There have been questions around what that 10% means. And again, I think, the big buzz is, and the big question is, we're expecting this outflow. As an individual, for the rand hedge that I'll see in protecting myself, I want to be able to take all of my money offshore. What are we thinking, firstly, that the impact to the economy will be? Do we think that this is going to be significant?
I mean, look, I think it's quite important to try and unpack what this means. So firstly, the change and the increase in the offshore levels from 30 to 45% is a really good thing for South African clients, right? And it's a really good thing. Absolutely, we're happy. We're very happy that it's increased because it gives you more flexibility. I mean, if you think about the SA environment, SA constitutes less than 1% of global markets from an index perspective, from a GDP perspective, and so more flexibility means that the potential for South African clients to generate more returns is better. So that's absolutely important to firstly recognize. You made an interesting point there around, a number of clients have been talking about going 100% offshore. And outside of your retirement fund, certainly there are ways to do that. And I guess what we're talking about here is more specifically the retirement assets that you've saved, which falls under that Regulation 28. And those assets are then limited to the 45% level offshore.
This obviously fundamentally changes the wealth management ecosystem within South Africa, and I'm aware that up until now we've obviously had that 30% available. As I understand it, that wasn't necessarily being fully utilized by asset managers? And can I, as an investor, expect that asset managers are going to be supplying and, not supplying, putting the full amount of that 45% that's available to me when I'm looking at various products?
Yeah, I mean, look, and that estimate that you mentioned, the 600 billion, 400 to 600 billion rands. I mean, so firstly, it sounds like a big number, right? So I think we've got to contextualize that to an extent. Um, Currently, a lot of pension funds are not far from that 30% level. So a lot of Regulation 28 funds in the unit trust industry, where a number of clients are invested, are probably close to 25 to 26%. So they're not that far off. And as you correctly ask, the question is, given that we've now increased to 45, will they get to that level? Because if they do get to that level, it does mean that this potential 4 to 600 billion rand will be invested outside of the country. And then the question becomes, where will that money be taken from? Because currently, the money outside of the global markets is a combination of SA equities, it's SA fixed income, so government bonds, SA credit. There's a number of different investments that people make in the SA economy, and so that money will then leave the SA economy to go into global markets. Uh, you know, I, the sense is that some managers will use that to go offshore. Some have done that already, and some will stay in SA assets until they see the opportunity to increase that level over time. So the assessment of that 4 to 600 billion rand is that it'll probably leave in the next 3 to 5 years in out of South Africa.
I mean, it is an overwhelming number, but I think the expectation in terms of how it affects markets, well, it depends on where that capital allocation comes from. But for me, it's great. And I think what would be a question that is on my mind is, how do I now approach this? Do I make sure that I'm running to service providers and just saying, take all my money, because now I've got the ability to have that much more exposure to an offshore environment? Or are there risks that I need to be aware of and thinking of?
Yeah, Lucy, that's exactly the right question people should be asking. What do you do about it? How do you choose the right investment? Because, with more flexibility and more power comes great responsibility, right? And so you need to make sure that when you're choosing to increase or change that level from whatever it is now closer to the 45% level, that you choose an advisor, because a lot of investors will have advisors that they use to advise them on how much to take offshore or where to invest. You need to make sure that the advisor has the skill set to choose that, because in the past, when the level was 30%, the selection was relatively simpler. Most of the 30% was allocated to global equities. So you choose the asset class that gives you the best growth, the best potential for returns. Now, increase is good, but it adds more complexity and more choice. So the increase means that not only can you invest in a global equity investment, so a stock like Amazon or Apple or something to that effect, but also you can invest into global bonds. You can invest potentially into other emerging markets, into emerging market income type of investments, into real estate globally. So you need to make sure that you've got the right financial advisor, and it makes it so much more important to ensure that your advisor has the skills to be able to allocate to those type of investments. So that's an important component of it. You then need to understand that the asset manager who your advisor has chosen has the ability to manage money on that basis, that they have the skills, they have both the people, the resources, to be able to allocate to those different asset classes over time. And there's going to be some winners and some losers. So some asset managers have built the skill set. Some asset managers have built it for a number of years, and some haven't. And so either they need to adapt and decide that this is a skill set they build over time, or they start managing a far smaller pool of assets in South Africa. So this is important. This is really the crux of what investors should be thinking about going forward. You asked a question about the volatility and the risks inherent here. There will be more volatility on the exchange rates. as an example, the volatility will increase because the amount of liquidity in the SA market is likely to decrease with that amount of money leaving the country. So there will be more volatility. And again, volatility creates opportunity for active asset management. So we're excited about it because it gives us the ability to generate more returns, more outperformance for clients over time. But what's important is that investors need to figure out who to select, and it's a right manager who can actually outperform over time.
And I think that also, just on the topic of having access to a much bigger global portfolio, the asset classes are also going to be different. And I imagine that with that comes differently structured products, but also products that are things that we're not necessarily going to have seen before within our service provision markets. Is that something that you foresee, having to restructure entire portfolios?
Yeah, I think so. I think the opportunity set will increase. I think the benefit is that you'll also see some global managers coming to South Africa. So that's already started to happen because the potential for them to raise assets is that much larger. And so I think the opportunity set for South African investors will improve. I think the potential for outperformance for returns will improve. But importantly, you've got to make sure you've selected the right provider, the right partner for the long term. Don't make short-term decisions. We've seen how value has been destroyed over the short term. And I think the other value of choosing the good advisor or choosing the right advisor is that the difference between somebody who does really well in a year or two or three and somebody who doesn't do as well in a year or two or three is going to widen, right? And unfortunately, in the past, what we've seen is investors tend to chase those who perform really well over short periods of time. And because this differential now increases, the potential, and we can call this probably badly like an incompetence cost. It sounds pretty rude, but it's just making the wrong decisions and not staying invested for the long term.
So due diligence is certainly fundamental prior to making those decisions. And I wonder, Sagneeth, and you may or may not have insight to this, we're very strongly controlled from a foreign exchange point of view. We were sitting at 30%, as you rightly corrected me. That's now been taken to 45%. Do we know why that decision has been made and why government has allowed this? And if we can expect to see those reins lessened even further in future? It's unlikely, but you certainly have more insight than I do.
Yeah, I mean, look, the intention and the expectation was that there will always be gradual relaxation over time. So, exchange controls in South Africa came into being in 1995. The level was set at 5% at that point in time, and over the last what is that 25 ish
Just about,
years,
yeah.
you've had or 20 years, you've kind of had the levels increase up to the levels that we are seeing at the moment. And so this expectation of gradual relaxation makes really good sense. I think what was surprising was 30 to 45% is a 50% increase. And so that caught people by surprise. But I don't think this is where it will stop over time. I think from 45, you'll continue to see levels of gradual relaxation over time. But this is a really important consideration because, as relaxations increase, the amount of money in South Africa, the capital into South Africa will reduce, obviously, as we've discussed. But what we've also seen, the flip side of this is that more money starts looking into economies where relaxation of exchange controls become more liberal. So as a country, you become more attractive for foreign investors when you don't have that much of exchange controls in the country. Now, in the South African context, when exchange control relaxation came into being in February of this year, the move from 30 to 45, we actually saw the rand take a little bit of a hit. So it weakened, but in the last few months, it started to strengthen again. So your viewers are saying, well, how is this possible?
We're undervalued.
And Yeah, and there's a few different things you need to consider. I think, SA as a commodity rich country has benefited from commodity prices
Mm.
over the last few months. So it's commodities back to the rescue for South Africa. And amongst emerging markets, if you think about the big kind of the BRIC emerging markets of Brazil, Russia, India, China, South Africa is looking fairly attractive relative to them. And so you've seen the strength because of those two factors, despite the exchange control relaxation. So you can't look at one in complete isolation. You can try and understand what the impact is on exchange control relaxation, but you've also got to understand the other elements, and that's why
Holistic
you've
aspect.
got to choose the right partner who
Yeah.
can make sense of all these moving parts and
Yeah.
make the right investment decisions for you.
It is complex, and it is. I think it's a lot for anyone to wrap their heads around. And I must say, having delved into it, my thought process around the changes is, well, this is bad for asset managers and SA Inc. with that capital outflow, and great for individuals. But the messaging that I'm getting from you is that actually it's good news all round, and the long term impact is just as good for the economy, actually, as it is for the investor who is now able to benefit from having more of their money offshore.
Look, I think there's certainly a number of providers who will benefit from this. But I think what is important is that there will be a separation between those who have built the skills or plan to build the skills and those who choose not to. So I think there'll still be that divide. And those who decide to build and invest for the future and the long term will probably come out as winners in the situation. And those who decide not to, will really struggle to survive. So I think it is quite a fundamental kind of tipping point in the asset management and the wealth management industry in South Africa. And you'll see those, winners and those losers if they've invested properly for the future.
Mm-hmm. Yeah, it's. I suppose it's going to be tumultuous as as things start to play out and kick off. Do we have any ideas in terms of, the relaxations of the regulations, as you mentioned, and when we might expect to see further relaxations? I don't suppose
Look,
that's something that we can predict.
Yeah, the last one we saw, I think, was back in about 2018. So it's been almost 4 years since those relaxations. Will we have to wait 4 years again? Will we have to wait more? It's hard to say, and I think to an extent it really is trying to understand what the macro position is of the country and how it is impacted as we see these relaxations. So it is dependent on a number of different factors. I would have it a stab of saying we probably have to wait another 4 or 5 years to see some relaxation for retirement funds. But maybe individual limits, maybe other institutional limits on the foreign side, will relax sooner than retirement funds.
Well, Sagneeth, this has been an insightful and good news story. I think it's good to know that as individuals, we have options in terms of exposure. And I'm personally quite excited to see how and what I'm going to be provided with in terms of, going and really utilizing that 45% limit and how that's going to benefit me. And your guidance and insights are very much appreciated. Thank you for your time.
Absolute pleasure. Thank you for having me, Lucy.
Thank you, Sagneeth.